Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are undertaking an intensive investigation into the sports data and technology infrastructure company, Genius Sports, trading under the ticker GENI.
And we're synthesizing two really crucial data points for you. First, their Q3 2025 earnings results, which they reported on November 4th.
And second, the detailed strategic roadmap they laid out at their Investor Day on December 3rd.
Our mission here is to investigate and synthesize these sources to give you a true understanding of where this business stands right now. We want a granular look at their recent financial execution.
Right, and we need to scrutinize their strategic positioning in what is an incredibly fast-moving sports tech landscape.
And maybe most importantly, we need to assess the confidence management has in achieving those ambitious long-term targets they've set for 2028.
You know, the core narrative that really emerged from these two events is one of accelerating momentum and a clear plan for structural leverage.
Yeah, that's a good way to put it. We saw Q3 deliver a massive revenue acceleration. 38% growth year over year.
And that was accompanied by a clear, confident plan to drive significant margin expansion, not just for the full year 2025, but a huge leap by 2028.
And the central thesis for that entire structural shift, it really lies in the maturation and the wide-scale deployment of their proprietary tech backbone. They call it the Genius IQ platform.
That's the key. Okay, so let's unpack this with the quantitative data right away. Let's start with that Q3 2025 financial performance.
Okay, so looking at the overall group performance for the third quarter, group revenue clocked in at $166.23 million.
Right. And as you mentioned, that 38% climb year over year is substantial, especially when you put it up against the, $120 million they reported in Q3 of 2024.
And management made a point of this. They explicitly noted this marks the strongest quarter of revenue growth the company has had since way back in Q1 2022.
So that level of reacceleration, it really suggests a definitive inflection point in their sales cycle. It's not just steady growth, it's speeding up.
And crucially, that strong revenue growth translated into robust growth on the profitability side. Group adjusted EBITDA increased by 32% year over year,
hitting $33.988 million in Q3 2025.
That performance resulted in a 20% adjusted EBITDA margin for the quarter. Achieving a 20% margin while you're still in a heavy investment phase, that really validates the underlying operational health of the core platform.
It absolutely validates the business model's ability to generate profit at scale. And we also need to recognize the cash flow picture. That's essential for any growth company transitioning toward maturity.
So what did that look like?
They generated strong, positive operating cash flow of $27 million in Q3.
Okay.
And management pointed out that this demonstrates the expected seasonality of the business. Cash generation typically shifts positive and accelerates during the second half of the calendar year.
Which makes sense. It coincides with the start of major sports seasons like the NFL and European soccer.
Exactly.
Now, here is where we encounter the necessary complexity when you're analyzing a high-growth company. The GAAP loss.
Right.
Despite that strong adjusted EBITDA, the GAAP net loss actually widened considerably. We saw a GAAP net loss of $28.814 million in Q3 2025.
And that's compared to a net loss of about $21.8 million in Q3 of 2024.
This led to a basic and diluted loss per share of negative 11 cents, which, if we look at analyst consensus, was a miss compared to the prior year's positive 5 cents.
And that spread. The $34 million in adjusted EBITDA versus the $28.8 million GAAP net loss. That is the single most important delta for any investor to understand.
It absolutely is.
It reflects management's intense focus on that adjusted metric, which excludes certain non-cash and non-routine expenses. We should dedicate the entire next section to really dissecting the components that create that gap.
Good idea. But first, let's quickly look at the year-to-date trajectory.
Okay. The trend line for the first 9 months, ending September 30th, shows a consistent accelerating business. Year-to-date revenue was $428.93 million.
Marking a solid 28% increase from the $335 million they reported in the same period in 2024.
And this is where the operating leverage they've already achieved begins to shine through so clearly. Year-to-date group adjusted EBITDA reached $88 million in 2025.
Which is a massive 65% increase over the $53 million they reported in 2024.
And that's the key metric right there. When your revenue growth is 28% and profitability growth is 65%. That is the mathematical proof of margin expansion and scalability.
Yeah, you can't argue with that math. But despite that leverage at the EBITDA line, the year-to-date consolidated net loss still widened significantly. It hit $90.96 million this year.
Compared to about $47 million in 2024. And the loss per share moved from negative 15 cents to negative 36 cents.
So this just repeatedly reinforces the need to look under the hood of that non-GAAP reconciliation to really understand the company's capital structure and their investment choices.
Right. Before we get to the costs, let's look at where that revenue growth is specifically coming from. Let's break it down by their three core segments: betting, media, and sports.
Yeah, this is where the strategic shifts become most apparent. Let's start with the betting segment. It's the largest, most established part of the business.
So betting revenue grew 28% year over year to $110 million in Q3. That's up from $86 million.
And year-to-date, betting revenue saw an even stronger 34% rise, reaching $304 million versus $227.
So the key takeaway there is that they are consistently outpacing the growth rate of the broader sports betting market. That suggests they're either gaining market share or successfully monetizing existing contracts at a higher rate.
Okay, but what's really exceptional, I think, is the performance of the media segment.
Oh, absolutely. This segment delivered a quarterly record revenue of $42 million.
Which represents an astonishing 89% increase year over year, up from $22 million.
And you have to remember, management had originally guided for this segment to grow at 50 to 60%. The 89% surge, it indicates that their strategy to move from being just a simple data provider to a key player in sports advertising is accelerating much, much faster than they anticipated.
We absolutely need to spend more time later exploring what catalyzed that specific outperformance.
For sure.
And then finally, the foundational sports segment, which provides data management and integrity solutions directly to the leagues, that grew 17% year over year to $14 million.
Right, up from $12 million. And year-to-date growth for sports revenue was also 17%, moving from $33 million to $39 million. It's a consistent, reliable revenue stream.
And we should note, management plans to consolidate this revenue into the betting and media segments starting in 2026.
Right, simplifying their external reporting structure, which really, it signals the maturity of the core offerings.
Okay, so if we look at the geographic trends, the growth story is overwhelmingly concentrated in the Americas, specifically the United States.
Yes, Q3 America's revenue grew 77% year over year, hitting $78 million compared to $44 million previously.
And the domestic market performance is truly remarkable. The United States alone saw 91% year-over-year growth.
91%, reaching $68 million in Q3, up from $35. And year-to-date, America's revenue grew 39% to $184 million, with $159 million of that coming just from the U.S.
It just confirms that the North American legalization and the rapid adoption of sports betting remains the primary engine of their revenue acceleration.
It does. But if you look beyond the U.S. boom, you see validation in the maturity of their global platform. Even in more established, more saturated markets like Europe, they demonstrated robust performance.
What were those numbers?
Q3 European revenue grew 16% year over year to $78 million. And year-to-date, European growth was 19% to $216 million.
So, for a market that isn't experiencing the same regulatory tailwinds as the U.S., maintaining double-digit growth well above the general market rate, that proves the sticky nature and the pricing power of their data content.
It really does. And the rest of world segment contributed solid growth too. Q3 revenue was up 28% to $10 million.
So geographically, the platform is expanding everywhere, but the sheer velocity of the U.S. market, particularly driven by that newfound strength in the media segment, that's the key variable here.
Absolutely.
That detailed financial breakdown really sets the stage, but as we established, the gross margin was suppressed despite the 38% revenue growth, and the GAAP net loss widened.
Right.
So now we switch to Section 2. The structural costs, the margin pressures, and the critical reconciliation between the GAAP and the adjusted metrics. Let's start with that gross margin issue.
This is an essential point for understanding the Q3 margin profile and why management remains so confident. While revenue was up 38%, gross profit only increased by a meager 3%.
Only 3%. Wow.
Yeah, hitting $41.2 million in Q3 2025 versus $40.0 $8 million the year before. That means the cost of revenue grew at an alarming rate. It rocketed to $124.9 million from $80 million year over year.
That is a staggering increase in the cost of sales relative to the revenue generated. What accounts for this severe temporary squeeze on the gross margin?
So management was very specific about this in the earnings call Q&A. This was a timing issue related to acquiring exclusive content rights.
Okay.
They specifically pointed to securing the exclusive data rights for Italy Serie A and the broader portfolio of European leagues early in Q3. The accounting rules require them to recognize 2 full months of rights fees, which are cost of revenue in August and September.
So they took the full expense hit immediately on the P&L.
Exactly, they absorb the expense. However, the associated revenue monetization from certain key sportsbook contracts that relied on this newly acquired data, it was delayed slightly.
Pushing recognition out until Q4 2025.
Specifically November, yes. This temporary timing mismatch, it suppressed the Q3 adjusted EBITDA margin, causing that 20% margin to be slightly lower than analysts may have expected.
And the CFO confirmed this would resolve itself.
Yes, confirmed they anticipate this issue to resolve completely in Q4, leading to a margin catch-up.
Okay, that provides critical context. It was a temporary accounting distortion related to a strategic investment, not a permanent structural failure of the margin.
Exactly.
Now let's look deeper into the operating expenses measured in thousands of dollars. Total operating expense increased significantly from about $46,000 in Q3 2024 to $67,000 in Q3 2025.
And breaking down the core expenses, sales and marketing increased commensurately with the revenue acceleration, rising to $13,645 from $9,455.
Which you'd expect, right? Especially given the aggressive push in the media segment where they're actively trying to court new agency spend.
For sure. But what really stands out here is the research and development spending. It showed a rare year-over-year reduction in cash expenses.
A reduction. How
I
much?
fell to $4,943 from $5,848. Now, R&D is still a strategic priority, but this suggests that the intensive capital investment period required to build the core Genius IQ platform may be plateauing.
Which aligns perfectly with what management has been saying, that the heavy upfront investment phase is largely behind them, and they're now focused on distribution and scale.
Precisely. Now, general and administrative expenses saw the biggest jump in operational costs. They rose substantially to $45,670 from $30,400.
GNA is a common place to expense overhead, corporate growth, and also often includes these non-routine, unusual costs that we need to look at.
Which brings us to the specific non-routine expenses. Transaction expenses jumped significantly to $2,667 from just $432.
That's almost certainly related to the recent acquisition of Sports Innovation Lab, or SAL, and other ongoing smaller M&A activities.
Right, which the company emphasizes are strategic and accretive. But the truly striking element here, which contributes greatly to that widening GAAP loss, is the increase in non-GAAP litigation and related costs.
These costs, which are non-cash adjusted back out of the GAAP net loss to calculate adjusted EBITDA, they soared to $9,598 in Q3 2025.
And that's up drastically from about $3,300 in Q3 2024.
Almost $10 million in legal costs in a single quarter is a major distraction and expense. These costs are related to ongoing legal proceedings. What? Sportscaster DMY, Spirable, and Volley Station litigations?
Right, and while management classifies these as non-routine, arguing they don't reflect core operating health, the fact remains that they are recurring, heavy expenses that shareholders are constantly financing.
This is the crux of the whole GAAP versus non-GAAP discussion. Let's look at the full reconciliation. Group-adjusted EBITDA hit $34 million from a starting point of a GAAP net loss of $28.8 million.
So what were the major components added back to bridge that $62 million gap?
Well, there are 3 primary components, and one of them is gigantic. Stock-based compensation was added back at $25.3 million.
$26 million.
That single non-cash expense accounts for nearly $26 million of the difference. As an investor, you have to ask, while this is non-cash, it is a significant recurring equity expense. Does excluding it really give us a truer picture of operational health?
That is the essential, critical question, and it's one management faces often. The argument they make is structural. They say stock-based comp, or SBC, is used globally by high-growth tech companies to conserve cash for R&D and platform scaling, and to attract top talent.
So they see it as a predictable part of their incentive scheme, but not reflective of the cash profitability of the core data business itself.
Exactly. And they attempt to mitigate the long-term impact by pointing to their share repurchase program, which we'll discuss later, designed specifically to offset this dilution. But you are absolutely correct. This is a real cost borne by shareholders through dilution.
That nuance is vital. Okay, so what were the other two major add backs?
Second, other depreciation and amortization, excluding acquired intangibles, totaled $16.519 million.
And this is the amortization of capitalized contract costs and internally developed software.
Right. This large figure is direct evidence of the intensive capital expenditure Genius has poured into building that Genius IQ platform over the last few years. While it's non-cash, it shows that the historical cash investment is now hitting the P&L.
So the SBC and the amortization of past investment account for well over $40 million of the difference. The last major item addresses macroeconomic uncertainty.
That would be the loss on foreign currency of $7.519 million in Q3 2025.
Which is a significant loss, and it dramatically contrasts with Q3 2024, where they actually reported a massive gain of $21 million on foreign currency.
That swing of over $28 million year over year just demonstrates how fluctuating exchange rates, given their global revenue base, can create significant temporary volatility in the reported GAAP bottom line.
Okay, that synthesis really clarifies the picture. The widening GAAP net loss is primarily a function of non-cash items like SBC and amortization, temporary items like the FX loss, and non-routine litigation costs.
And the underlying segment-level profitability, measured by adjusted EBITDA, confirms the cash-generating ability of the core business, even if shareholders must accept that substantial equity dilution from SBC.
Now that we've established the robust Q3 numbers and clarified the structural costs, we need to transition to the strategic engine driving this growth, the product success, and the competitive moat they outlined at Investor Day.
Right. Let's start with the largest segment, betting, and the growing importance of in-play activity.
So the betting segment's success is built on three pillars: content exclusivity, partner deep integration, and the structural tailwind of in-play betting.
Exactly. Securing those exclusive rights like the European leagues and Serie A during Q3 wasn't just about revenue. It was about protecting and strengthening their data feed monopoly for these specific assets on a global scale.
And the commitment to stability is clear. Management explicitly stated that they are contracted through to the end of the decade with most of their most valuable content partners.
And in this industry, long-term exclusive content rights are the bedrock of reliable revenue.
And beyond content acquisition, they're focusing on product expansion with key operators.
Right. They renewed their partnership with Hard Rock Bet, integrating more content, live trading solutions, and their flagship product, BetVision.
And critically, they also expanded their partnership with ESPN Bet to ensure BetVision access for that rapidly growing operator.
Which brings us to where the economics get truly compelling. The in-play tailwind. We know Genius consistently earns a massive 3 times higher revenue share on in-play versus pre-match activity in the U.S. market.
And the adoption rate of in-play is now accelerating significantly.
Indeed. We saw data that NFL in-play betting, which was sitting around 20% of the total handle at their last Investor Day a year ago, has now risen sharply to circa 30%.
That is massive growth for their most profitable type of bet.
And the insight here is to define the potential. If you look at mature international markets, they typically sit at 60 to 70% in-play handle penetration.
So the U.S. market at 30% suggests an enormous growth runway for Genius's higher margin variable revenue streams over the next 5 to 10 years.
Purely driven by consumer behavior catching up to mature market norms. And BetVision is the key driver of this behavioral change.
That's the product that combines a low-latency live streaming feed with integrated real-time betting data.
Right. And the metrics demonstrate strong consumer adoption. They reported a 35% annual increase in unique devices using BetVision and a 50% annual increase in North American sportsbook customers accessing the product.
Those are strong adoption numbers, but the engagement data is truly sticky.
It is. The in-play handle as a percentage of total handle specifically on BetVision is 74%.
So BetVision users are overwhelmingly shifting their behavior toward the most profitable action for Genius and its partners.
And on top of that, the average time spent on BetVision annually increased by 25%. This high level of engagement translates directly into higher lifetime value, or LTV, for the sportsbook operators, making BetVision an indispensable tool.
And that intense engagement feeds perfectly into the second part of their strategic engine, the media segment, the one that delivered that exceptional 89% growth.
Right. So what specifically enabled that massive outperformance that exceeded their own guidance of 50 to 60% growth?
Well, the outperformance was attributed primarily to advertising agencies recognizing strong, measurable returns on their spend through the Genius platform.
And consequently increasing their budgets.
Yeah.
This is the shift from discretionary marketing spend to performance-based, high ROI advertising, what many are calling the retail media for sport.
And the recent acquisition of Sports Innovation Lab, or SIL, is central to this whole strategy. This acquisition wasn't just about personnel, it was about accelerating their capability to unlock a deeper behavioral understanding of sports audiences.
And how they spend their money, both on betting and on consumer goods. This leads us directly to the concept of the FN Hub ID.
Okay, so if we look at a standard identity solution like a cookie, it's often ephemeral and disconnected from real-world behavior.
Exactly. The FN Hub ID is a proprietary identity graph built on billions of transactional data points, meaning data from actual purchases, betting actions, event attendance covering over 200 million fans globally.
So if I'm understanding this correctly, the FAN Hub ID is fundamentally different because it bridges the gap between who is watching the game and what they're actually betting on or buying.
Precisely. It allows Genius to link deterministic data, the fan's betting history and preference profile, to their media consumption. That creates the precision necessary for targeted, high ROI advertising.
For example, knowing who placed a specific in-play parlay gives you a deeper, more actionable profile than just knowing someone watched a generic sports channel.
That capability allows them to target highly specific consumer segments, which is why agencies are increasing their spend.
And this data intelligence allows them to create unique, high-value advertising inventory that their competitors simply don't have access to. Give us some examples of this unique inventory.
They highlighted 3 compelling examples. First, the inventory created directly on the BetVision streams for NFL, soccer, and basketball. They're streaming over 20,000 live events this year, so that's a massive pool of inventory.
And crucially, because fans on BetVision are 3 times more engaged than the average viewer, that ad inventory commands a premium price. It's a captive, high-intent audience.
Exactly. Second, they are augmenting advertising content delivered from major brands like Shopify, NBA 2K, and Point 3 during WNBA games shown in the FanDuel Sports Network.
And this augmentation uses technology triggered by real-time data, right? Like a player hitting a milestone or a team calling a timeout.
Right. It transforms that key moment in the broadcast into a dynamic, premium sponsorship opportunity live on air. It's personalized broadcast advertising in real time.
What's so fascinating here is that the core technological advantage that underpins both the betting segment's adoption and the media segment's performance is the Genius IQ ecosystem.
Which management explicitly calls the operating system of sport. This is where we really need to address the idea of their competitive moat.
So Genius IQ is the high-tech foundation, the data and AI layer of their tech stack. It uses a proprietary mesh network of iPhones installed in stadiums and venues globally.
And the significance there is the replacement of costly, complex, and clunky legacy optical tracking systems that require specialized hardware and personnel.
So why is the iPhone network essentially commercial, off-the-shelf devices such a revolutionary competitive advantage?
It's all about cost, scale, and time to deployment. By using relatively low-cost, standardized iPhones running the proprietary software, they dramatically reduce the capital expenditure and the maintenance complexity.
And that allows them to scale rapidly.
And once deployed, this edge device setup captures granular, real-time data, it auto-events video, and generates a sophisticated 3D digital twin of the game environment.
This shift is crucial. It changes Genius from being a data vendor where data could theoretically be sourced elsewhere to an infrastructure utility.
That's the core insight you need to remember. They're embedding themselves as infrastructure. They're deploying this globally. Genius IQ is already in over 300 venues across 60 countries.
With ambitious plans for more than 400 additional installations.
Every time they secure an installation, they become stickier and harder to replace. They are creating a proprietary physical data capture network on a global scale.
And this single data foundation then powers all their downstream products. Performance Studio for teams, BetVision for fans, broadcast augmentation for media partners, and the augmented advertising campaigns we just discussed.
It's a powerful flywheel effect. Increasing the number of Genius IQ deployments generates more high-quality data, which drives better products, which attracts more partners, creating more defensible, high-margin revenue.
We've established the strong Q3 performance and the technological backbone provided by Genius IQ. Now we have to turn to Section 4, the near-term guidance revisions and, more importantly, the audacious long-term 2028 financial outlook that really defines the investment thesis.
Right. Management showed palpable confidence by raising their full-year 2025 guidance across the board, signaling that the Q3 momentum is sustainable.
For group revenue, they raised the target to $655 million, confirming a projected 28% growth year over year.
And for profitability, the increase was even more significant. They raised group-adjusted EBITDA guidance to $136 million.
Which translates to a massive 59% growth year on year compared to 2024. This reflects a projected 21% adjusted EBITDA margin for the entire fiscal year 2025.
An expansion of about 400 basis points compared to FY 2024. This demonstrates the leverage is already kicking in.
And reflecting their transition, management was highly confident in their operational stability, explicitly stating they are on track for positive operating cash flow for the entire fiscal year 2025.
Which means the business has decisively moved past that cash-intensive, heavy investment period, generating cash internally to fund future growth.
Now for the long view, the 2028 financial targets. These figures are the ultimate test of the scalability of the Genius IQ platform and define the investment thesis for the next several years.
They're targeting $1.2 billion in group revenue by 2028.
That represents a 22% compound annual growth rate, or CAGR, from the projected 2025 revenue of $655 million.
And for listeners unfamiliar with the term, CAGR is just the average annual growth rate over a specified period. Achieving 22% average growth over 3 years on a base this size is aggressive, but it reflects their confidence.
Okay, so $1.2 billion in revenue. What about profitability?
The expected margin expansion accelerates dramatically in this plan. They are targeting group-adjusted EBITDA of $365 million by 2028.
Which reflects a staggering 39% CAGR from 2025 estimates.
And this leads to the absolute critical figure for assessing their operating leverage, an adjusted EBITDA margin target of 30% by 2028.
That is a massive 900 basis point expansion from the 21% expected in 2025. Hitting a 30% EBITDA margin. That is the hallmark of a mature, capital-efficient technology platform.
It is. And the Investor Day provided the granular detail needed to justify this confidence. Management outlined a very predictable cost structure expected at that $1.2 billion revenue level.
So they're showing precisely where the operating leverage will come from. Let's review those target cost percentages for 2028 relative to the $1.2 billion in revenue.
Okay. Rights fees, which are the predictable input costs for their betting content, are expected to stabilize at 35% of revenue.
That 35% is the stable cost foundation.
Then, if we look at the operating costs, the leverage from the heavy past investment in Genius IQ becomes undeniable. Media direct costs are projected at 10% and other direct costs at 10%. But look at the OpEx lines.
This is where it gets highly analytical. Sales and marketing expense is projected to drop to just 3% of revenue.
That percentage is the mathematical definition of a scaling platform utility. Consider that many high-growth, sales-driven software companies often maintain S&M expenses at 20 or even 25% of revenue.
Because they rely on human sales effort to push product?
Exactly. Genius, by projecting S&M at 3%, is confirming their position as an essential infrastructure layer, where demand is largely organic, driven by the indispensability of the data, not by massive outbound sales forces.
And that structural efficiency continues into R&D, which is projected at only 2% of revenue by 2028. And G&A costs are targeted at 10%.
These low OpEx percentage targets confirm that once they hit that $1.2 billion threshold, incremental revenue will largely drop straight to the bottom line, accelerating the margin expansion towards that 30% target.
That's the essence of scaling infrastructure.
Furthermore, they are intensely focused on cash flow conversion. They expect free cash flow conversion to hit 60% of adjusted EBITDA by 2028.
Which would equate to approximately $220 million in annual free cash flow.
And this focus on free cash flow compounding is a clear, unambiguous signal to the market that the business model is maturing rapidly.
But the largest single component of this future margin expansion relies on the high margin lever in their media segment strategy.
Right. That segment is targeted to hit $300 million in revenue by 2028, up significantly from the $135 million expected for full year 2025.
And crucially, this growth is heavily reliant on shifting advertising spend toward the self-serve model.
The self-serve model is the critical path to that 30% margin. In their traditional managed spend model, Genius acts like a full-service agency. They source the inventory, manage the campaign. Their margin is net of direct media costs.
But with the self-serve model,
The margin is nearly 100% incremental. Think of the difference between a white-glove agency placement and running a campaign through a self-service platform like Google Ads.
if an advertiser simply utilizes the Genius IQ data and tools on a self-serve basis to target fans, that revenue bypasses most of the direct costs and drops almost entirely to the bottom line.
Right. And management anticipates that the total advertising spend flowing through the Genius platform, both managed and self-serve, will reach about $500 million by 2028.
So as that $500 million shifts increasingly towards self-serve, the margin profile of the entire media business will skyrocket, providing the lift to achieve that ambitious 30% group-adjusted EBITDA margin target.
Shifting now to Section 5, we should turn to competition and future risks. We have to address the competitive challenge that's been top of mind for many institutional shareholders:
Prediction markets.
prediction markets. This topic was addressed with great detail and confidence at the Investor Day, as they're often viewed as a potential disruptor or competitor to traditional online sports betting, or OSB.
So what was management's take?
They confirmed they are observing the market carefully and prioritize compliance with all relevant laws and regulators. But their stance is that prediction markets are currently an additive opportunity that expands the total addressable market.
So it expands the TAM for sport consumption and requires essentially no incremental cost for Genius to integrate with or monetize.
That's the argument. And they provided crucial quantitative data comparing prediction markets to traditional OSB. The comparison fundamentally argues that these are structurally different businesses serving different consumers.
Give us those specifics. Why are prediction markets structurally less valuable to the operators?
Okay, first, market share. Prediction markets structurally settle into low single-digit market share in mature geographies. Second, commission. They operate on a low single-digit commission rate compared to double-digit margins for traditional OSB operators.
And third, and this is probably the most defining for the operator's business model,
Customer lifetime value, or LTV. In prediction markets, it's only 15% of that of an OSB customer.
So just to clarify for our audience, LTV is the net profit attributed to the entire future relationship with a customer. If the LTV is only 15% of a traditional sports bettor, that consumer is fundamentally a lower value target for operators.
That is the clear implication. Genius is essentially saying that prediction markets serve a high-volume, low-margin, lower-value consumer base.
And because they're structurally less profitable for the operator, they won't divert significant capital or marketing away from the core OSB customer base.
Precisely. Furthermore, Genius already sells data to exchanges and firms globally. They argued that the need for official league data, marks, logos, and integrity solutions will only grow as prediction markets become more sophisticated and regulated.
The conclusion from management was a very strong statement of competitive confidence. They said, in every scenario, Genius wins.
Right. They believe that whether prediction markets face prolonged regulatory uncertainty, create market fragmentation, or achieve eventual federal clarity, Genius will always supply the necessary data infrastructure to all participants.
And that confidence stems directly from their position as the content infrastructure provider. If you need official league data to run a regulated market, you have to go through them or their competitor.
That shift to infrastructure utility gives them protection regardless of how adjacent consumer markets evolve.
We must also address the necessary risks and challenges. The reliance on external partnerships always presents a risk profile for the company.
Absolutely. The primary risk acknowledged by the company remains their reliance on relationships with sports organizations and the potential loss or failure to renew those existing relationships.
If a major league like the NFL chose to internalize data distribution, that would pose a significant threat. That content underpins the entire $1.2 billion revenue plan.
Secondarily, there are persistent risks related to fraud, corruption, or negligence involving sports events or personnel. This is inherent to the industry and underscores the crucial need for their integrity solutions business.
Especially considering the recent public integrity issues seen in the NBA and the UFC.
There are also persistent costly risks related to changes in domestic and foreign laws and regulations, specifically with prediction markets. And finally, litigation and investigations like the specific ones we mentioned remain an ongoing cost and managerial distraction.
So, with the anticipated growth in profitability and cash generation by 2028, how is management planning to allocate that growing cash pile?
They outlined three key capital allocation priorities for shareholders. First is organic reinvestment. They will continue spending heavily on Genius IQ development and global distribution.
And out of the projected $365 million in adjusted EBITDA in 2028, they expect to allocate 15 to 20% to capital software capex.
And another 5 to 10% toward Genius IQ installations worldwide. This confirms the scaling phase still requires material capital to cement that infrastructure utility stack.
Okay, what's second?
M&A. They remain highly disciplined, focusing only on strategic acquisitions that are clearly accretive to growth, margin, and the cash flow trajectory. They cited the Sports Innovation Lab acquisition as the benchmark for this disciplined approach.
So M&A won't be used simply for scale, but for technological and data advantage.
And third, share repurchases. They authorized a significant $100 million share repurchase program to be deployed opportunistically.
And crucially, this program is intended to potentially offset the inevitable share count dilution from that high stock-based compensation, the $26 million non-cash expense we discussed earlier.
Right. They expect that, net of repurchases, the annual share dilution will remain a low single-digit percentage per year.
Finally, let's briefly but thoroughly review the upside opportunities they mentioned that are not currently built into their base case targets. This is the realm of potential alpha generation.
Well, the largest conceptual upside is the strategic vision for third-party applications built on the Genius IQ platform. Mark Law compared Genius IQ to the App Store of sport.
Which implies a future economy where developers, teams, and brands build applications that all rely on the Genius platform's proprietary real-time data API.
It's a powerful analogy. If Genius becomes the operating system, what kind of applications could utilize that underlying data feed and create high-margin incremental revenue for Genius?
You could think about AI-driven scouting and performance analysis tools for clubs that want more granular insights than their own systems can provide.
Or imagine personalized, hyper-localized betting interfaces built by third-party tech firms that sit atop Genius data. Or proprietary fan token platforms that rely on Genius IQ data to power dynamic rewards based on in-game events.
And every application built on this platform increases the platform's value and provides Genius with a high-margin data access fee. It creates a network effect that isn't yet fully factored into the 2028 targets.
And there are two other operational upsides that could accelerate their margins even faster. First, cost efficiencies derived from automated data collection or auto-eventing, which reduces the reliance on expensive manual labor.
A direct benefit of the Genius IQ deployment.
And finally, an accelerated shift by advertisers to that high-margin self-serve media model. If that $500 million of total ad spend flows into self-serve faster than predicted, that 30% margin target would rapidly increase.
Moving Genius even quicker into that free cash flow compounding phase. So what does this all mean in synthesis for you, the investor?
The core thesis is that Genius Sports is successfully executing its transition from a specialized data vendor to an essential infrastructure platform.
And that platform, Genius IQ, is creating a powerful and accelerating flywheel effect. It's driving consistent outperformance in their core betting segment and accelerating the structural high-margin transformation in their media segment.
This convergence of stable, exclusive content and leveraged, scalable technology gives management high conviction in achieving those massive $1.2 billion revenue and 30% margin targets for 2028.
They're demonstrating the ability to transition from a heavy investment growth company to a free cash flow generating utility.
And the confidence is warranted, stemming from the technological moat they are building by deploying Genius IQ in over 300 venues now, with plans for 400 more, solidifying their position as the underlying data layer for global sports monetization.
So if we connect this back to the broader picture of sports consumption, Genius is creating what they call a true digital twin of sporting events.
So think about this. If Genius is the platform underpinning every future application built for sport, from how you consume personalized broadcasts to where your favorite team sources its scouting data, how quickly will this fundamental change in infrastructure monetize every single sporting event on the planet?
Fundamentally changing your experience as a fan and a consumer. And if this platform is truly the operating system for the future of sport, we have to consider how valuable the entire ecosystem will be when those 400 future Genies IQ venue installations finally come online.
And start generating data streams that fuel that app store of sport. The financial implications of that infrastructural completeness are likely far beyond the current $1.2 billion target.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.